And joining me on the podcast right now and on video, full surround sound, Technicolor, it's full-time analyst, full in your face, it's Paul Hill. You all right, fella?
Yeah, morning, Justin.
Do you know, quite bullish news. I mean, we sort of knew this, but I mean, you said Bank of England came out this week saying it's going to have growth like we've never seen it since World War II. So you realise we have been through such an historical event, you know, selling off, every country locking down, forced recession. It's an historical thing, but it's good. And I know if you're judging by my wife, then there's a lot of spending going on. I don't know. Halfway through this,
what should we do? Tell me, spill the beans.
I always look at the property market, right? But that's gone berserk. We could talk about that later. I mean, I've seen house prices in my area got by 50% in some areas. It was a ridiculous amount. So I thought, what? And some of them are just chancing their arm, I think. You know, we say, no, it's a stamp duty holiday and all that stuff. So we decided to spend on the house we're in. So a new patio, there's new stuff happening at the front, like sort of rendering and all that kind of stuff going on, and new sofas, painting inside the house.
So she's the reason for the sort of the governor of the Bank of England upgrading GDP estimates.
Well, I'm assuming the governor's wife is doing the same, probably. So I think, hang on, this is where we base our spending on. It's almost like that one up on Wall Street, isn't it? That the book where he says, base your investment decisions on people around you, trends you see happening. Sometimes you can get one up on Wall Street by just seeing what normal people are doing, and seeing what's happening. There's certain brands. I remember a long time back. Who was it? The clothes company which was listed, part of Associated British Foods. Primark it was, wasn't it? Yeah. And Primark became very, very popular. And I thought, wow. But the trouble is, it wasn't obviously a solely listed company. That's the problem. But and everyone's like, well, Primark, and that was way before the share price really caught on, or it took off a little bit. But those kind of things, you can sense those kind of trends happening, can't you, sometimes, around you?
I mean, you raise a very good point. I mean, just look at the reports and the results from the building materials and building products industry. All of those suppliers are just like knocking the ball out of the park, not only on volume, they've got very short supply, there aren't enough stocks, like the bricks, for instance, but also pricing. Pricing's really moving on. And then what's happening is that's then being put into the repair, maintenance, installation, which is people like yourself who are upgrading the houses, etc. They've got plenty of money because they've been saving for 12 months, and then you've got new people buying houses, whether it's existing properties and then they want to do repair it, etc., or alternatively a new property. And just look at the house builders, and they're passing those costs on, so it's not impacting margins. And that's the important bit. Where you want to play in the stock market is companies that have actually pricing power and strong demand. And you've got a double whammy. I mean, obviously you got this huge lift in anything infrastructure, property related, certainly on the residential side. But also, I mean, you look at the announcements from the government, and everybody's going to be, not everybody, but a lot of people are going to be forced to staycation this year, and that's another real rocket underneath the GDP, and that's why it's moved their estimates from 5% for 7% this year, because it's really tough to even find a campsite.
Well, I know, and not only that, what happens if I've talked to some of the guy Jamie here, who's got 4 guys working with on the patio, and I said, are you busy? He said, we're booked out for months. I spoke to a plumber coming to do the plumbing. He said, I'm booked out till January. It's literally that busy. You see that knock-on effect. And in fact, another bit of news here. Let me just, I found it, I don't know if you saw this, but TUI now, and this sort of plays into some of the stocks you've talked about previously, they're going to start subsidizing, tests, aren't they? COVID tests. Because of course, you've got to have this now. And you can, is it this weekend or next weekend? They're going to start talking about the green light destinations. Yeah, because the destinations you can travel to safely, but obviously some destinations still need tests and come back in. But some saying that's very expensive, and now TUI, the biggest operator, saying we'll subsidize that, and you can get them for between 20 and 90. So what's the difference between 20 and 90? Is that the speed of the test or the quality? It can't be the quality. It's going to be speed, is it? I don't understand wide range.
I don't know what they're asking. I mean, normally 90 is probably a PCR test. Probably a lateral flow is a 20. I don't know. They're probably, that's the likelihood. It's just a different sort of price point for a different sort of level of accuracy with what you want. And obviously, if you have a lateral flow, then you're going to run the risk if you get to the other destination and you're going to get a negative PCR. I don't know how they're actually pricing it, but yeah, that's good news. I mean, I did see it's going to be a slow burn though on the reopening, because I think there's only Portugal, Malta, and Gibraltar in Europe who are going to be opened up.
I bet they're rubbing their hands, and then
America's likely to be on a sort of like a corridor, one of these safe corridors with the UK, because they've got similar levels of vaccination rates. But I think Spain and France are still on amber, or going to be. So that's going to, again, incentivize people to stay at home, spend at home. And again, you try and actually book a flipping restaurant, seat. I mean, there were some quite good stats, actually. Last week, they had... only because, even though you're only allowed to sit outside, 70%, we were back to levels of 70% of pre-pandemic levels of people sitting down and dining. And that's outside in the rain during hailstorms. And I've seen people.
Yeah, well, do you know what? My local public said they've really developed the outside area, almost covered it pretty much.
Yes.
With a nice booze and all that stuff. So now when they go back to normal, they'll have double the capacity. You can have people sitting outside with heaters and all that stuff, and inside. So have double the capacity, so it'll really benefit them in the long run. But like I say, they're going to get so busy holidays. In fact, another bit of news from the chief executive of Booking.com said, holiday prices are already going up. There's limited. They're hoping to get 70% of. I think that's quite ambitious, but there's limited. Airlines flights schedules on, and you got all these people wanting to go to 3 countries. I mean, if you're in those countries, what are you going to do? Check your prices, aren't you? Yeah, the demand's going to be huge.
And also, you look at sort of like, credit card spend, and in the latest data for the last 3 weeks, we've basically been back to pre-pandemic levels, 99% of what it was the week before we went into lockdown. So frankly, credit card spending's back there. And if you look at, you probably noticed as well the amount of traffic on the road. I mean, I had a quick look at the Apple mobility data from iPhones, and across Europe, across England, then we're past where we were in February of last year, slightly higher in terms of the number of congestion. We're not on public transport, so it just says to me the economy is healing. We still haven't yet got out fully into lockdown. There's massive pent-up demand. So I mean, I could actually see this 7% GDP increase estimate by the Bank of England being upgraded again, because people are going to they just want to spend, don't they? I mean, they want to get out.
Do you know what the worry? Yeah, exactly. But the worry about this, like you say, there's pent up demand. So the demand is there, but supply isn't quite there on many things, and we know what happens then. So you've got pricing. Exactly, and inflation. Because you've got, but again,
what have I been saying?
but surely, I mean, for example, with flights and holidays, let's say it's a limited destination you go to. There are countries behind us on their vaccination programs, of course, and there's variants and all that stuff. So they'll be slower coming, to open up. So you'll have this. I think, but it may peak though. Isn't it temporary, transitional? This inflation, it'll come back down once, because it is all about vaccinations and testing, pretty much. Well, vaccinations, isn't it?
Yeah, I mean that's what the Bank of England governor says, and likewise the guy over in the Fed, Jerome Powell. But I've said to you many times, I don't believe it's just transitional. Yes, you'll get a spike and then it will come down a bit, but there's no way it's going to hit 2%. And there's lots of reasons why. But the biggest single one is that governments are absolutely saddled with huge mountains, Himalayas of, sort of debt. And the only way they can rebalance that in terms of GDP is to inflate it gradually away of sort of like 3, 4, 5%, and that's what will happen. And then you'll get it. You'll have that coming back to sort of 100% of GDP total government debt in about 5-10 years time. And people will say, well, okay, well, fine. The only way you can protect yourself is to have assets, stocks, houses, and things like gold and other physical assets. I mean, people say Bitcoin's a safe haven. It's about as safe as probably my DIY, I think, but which isn't very.
I'm genuinely. I think the crypto market is insane. The fact that I attempted into it a couple of weeks back means it's insane. Like I say, you got Dogecoin valued at 80 billion, which is like more highly valued than most FTSE 100 companies that are proper businesses. And that's a picture of a dog. Like, that doesn't simplify how insane and crazy that crypto world is. But people believe in it, It's like anything. When you get herds of people believing, chanting the same thing, believing it, I think Ethereum is probably, the best one to hold, probably, because that's like the internet of all apps, all decentralized apps are based on Ethereum, pretty much. Bitcoin, okay, maybe it's an asset, but the rest of them, they can fall by 95% in valuation and they'll still be overvalued. It's like, who knows what they do? It's like nuts. I don't think everybody listening and watching this saying, no, you just don't understand it. It's all about decentralization. It doesn't matter. In fact, I read a startup guy, very good. I should retweet it, but he was talking about he had a project on about crypto, and he was saying that basically when you're in crypto and trying to develop this coin, you long for centralization. You need centralization to get the decentralization and all that stuff. It was very interesting. But yeah, no, I think it's super valuable, and I'm wondering, because there's now we got the crossover mainstream investing in crypto, whether a big sell-off in that will lead to a bit of a sell-off in the real market. First time
Hey,
ever.
mate, I pointed that out about 2 months ago. I said that was a
Yeah.
big risk. You could have it. It could actually take
Yeah.
a lot of momentum out of the market, and you could get a
Yeah.
selling beget selling. But before we move on, before we move off the sort of like the the COVID testing side, which you mentioned, if people go abroad, they've got to have PCR tests and people and TUI are subsidising and stuff. That is a really interesting space to play, and for a number of reasons. First of all, and I've talked about it a bit, SourceBio do PCR testing, and if everybody's got to get PCR tested twice who go abroad, then that's going to do well. What was also really interesting is I didn't realise, but the UK government at the moment is genomics, is sequencing every single positive, or nearly every single positive COVID infection result. And all that means is, when you spoke to Jay LeQ at the Ethereum, he said to you, we're actually, our genomic sequencing division is doing really well. Well, that's the reason why. It's simply everybody in the UK is having to have their tests with a positive test sequence. So they're going to do well in that respect. And then also the other reason why it's really interesting, and just the broad perspective in COVID testing, is the government is very shortly going to decide on what are its default tests for PCR and its suppliers, along with its rapid flow, antigen tests and stuff. And the companies obviously right in play for those are likes of a Vactor, Omega Diagnostics, which have got to test itself and do manufacturing. You've got Novacyte, and you've also got another interesting one. And those decisions I think will be made in the next month or so. The PCR tests, they're coming out. It's lot 3, I think it is the really big one. But anyway, so that's going to be big news. But the other really quite interesting one, which nobody really gets their head around, is actually, when they came out this week, is Oncimmune. And Oncimmune's quite an interesting one because it had first of all some news that its lead cancer early detection screen, it was taking back the rights and the IPR from its Chinese distributor back into the UK. And that's great because it gives them the flexibility then to, if it wants to, I mean, hypothetically, if ever wanted to bring that, dovetail its test with its partners in the US, Biodesics, then combining those two, you get a really balanced test, and you can potentially put it out even into China. And obviously everybody knows that smoking is massive in China and lung cancer is huge. So but coming back on the COVID side, which is again something people haven't really seen, is they've done an infectious disease panel for COVID. And one of the real killers of COVID, as everybody knows, is this COVID storm, where you get a huge autoimmune reaction, and it basically attacks your body, all your lungs. But also there was a Yale study not long ago, which was one of the reasons they're saying this autoimmune response has caused long COVID, because it damages your brain, it damages your lungs and stuff like that. Who is in the able position with one of the world's biggest auto antibody biobanks in the world? It's about 8,000 or plus proteins it's analyzed. It's Oncimmune. And that's why Roche and Cedars-Sinai have wanted to actually develop their own products using that unique IPR that Oncimmune have. So they could really do well in an area that people have not seen. So I would say, to people who own this stock, last week's news was fabulous because it gives them that optionality, and also what it allows them to do, which they've said they're going to do, is look to raise some money on the US markets, which could lead to a re-rating. And equally with that, the test that from Biodesics out in the States, their partner, they're coming out results on Monday, I think it is, or it's about the 10th or 11th or something like that. So have a look at those results. But I think this COVID side is really under the radar, because how many people have got long COVID? Well, I know at least there's 10% of the NHS's staff have long COVID. They are desperate to get those guys back to work. And therefore you need leading IPR to help to create the treatments and diagnostics to be able to sort that problem out going forward. Never mind, obviously, the general population. And they're really in a very good position. If Roche can't do this themselves, then that means that they've got something. So I would definitely, have a look at sort of Oncimmune, because I think they're under the radar. People obviously have priced some of but not all of their service, which is the Immuno Insights service and platform. But those things are really good in terms of that infectious disease with COVID and the early CDD test. So something to look forward to, I think. But
yeah. Do you know what? Just mentioning long COVID there. I may as well mention Polarean off the back of that, because they've just come up with Stifel, their new big sort of broker they moved to, has come up with their first sort of detailed note on them, and the FDA clearance for their drug device is on the 5th of October, and they've come out with say a 90. Yeah, it's a 90.
Wow, that is going to be one big day for the shares. Month's time.
I think before that, so upon approval, they see a 90% probability of it happening. Because let's be honest, they've had a pre-FDA meeting. Their phase 3 trials, or all the trials.
If it's 90%, Justin, it's priced in. That's not you want it.
No, that's. But hang on a second. They've seen a 50% upside on that thing there, and they're talking about 167 million in revenue by 2030, and that's just basic. Do you know what? I was talking to Richard, and Richard was saying that they're saying, if you look at Stifel, they've got a unique ability, their tech, to visualize 3 vital aspects of lung function. That's ventilation, gas exchange, and microvascular blood flow. And no existing lung imaging technology can provide that. And like I said, Richard said in a recent presentation, within 10 years, they see polarizers in most hospitals. It's an add-on, or even, added to manufacturing on MRI scanners. And these are guys that have they applied for what's called Hatch-Waxman exclusivity, 5 to 7 years. So they get that. They'll be supplying the market pretty much, the entire market for 5 to 7 years. So I think 50% upside to the before October is quite conservative. I think it's going to be.
I'll be watching that. We should do a podcast sort of like on the 4th, and we'll run a sweepstake about what the result's going to be.
Well, it's funny that if you look at it, right. So basically, they've had a pre-FDA meeting, the submission, which I think it's essentially like someone marking your homework before you submit it. The teacher saying, "Okay, maybe we'll look at that." And and also the clinical trials were designed and approved by the FDA, of course, all that stuff, and they passed flying colours. So I think it's pretty much. I mean, you never know, but they say 90%. Now they have to say that. They can't say 99%, I suppose. But it seemed pretty much a formal exercise. They may have some kind of issues or collaborative issues, and they go back on. But
can I make a prediction? Can I make a prediction on this one? Right. Let's assume you're correct. Yeah. And that 90% probability.
Always am, yeah.
Exactly. That 90% probability is right. Okay. And they get FDA approval. I'll make a prediction within 12 months. So let the 4th of October, 2022, Polarean would have been bought out by a US MRI scanner, sort of like.
Yeah, well, I mean, it's too big.
It's going to be taken out.
There's 2 big diagnostic companies on the whole shares are significant holders. So
okay, well, it might even better than have a fight over it, because if that gets approval, it's a game changer for that technology. And you'd be crazy if they get approval. If it takes a pop and then comes down a month later, you'd be crazy to sell, because that looks like an absolute perfect acquisition target. In
fact, Joe, I did a video on this. If you look at the last big sort of milestone, that was phase 3 announcement. The share price rose by, I think, like 50-60% beforehand, within a month before, but 50-60% months before. And then everyone sort of knew they needed to raise some funds. So it literally dipped massively afterwards. And they raised some funds, no problem at all. But, that was the opportunity. So sometimes, obviously, with share prices, it's always the same. That's why people don't understand. Sometimes you get some good news out and the share price goes down. Look at the chart beforehand. It's risen on the way up to that news, and it's baked in, So, So we've got 5 months yet. 5 months. I think it was 5 months 2 days ago. It was exactly. So, and who knows? The FDA are probably quite busy at the moment, so it may even be a little bit delayed. Who knows?
Yeah. I mean, there's a lot that raises another trend. It's sort of acquisitions and M&A. I mean, obviously, one of the companies I've talked about, Proactis, got taken out last week.
It's a good price, wasn't it? Nice price.
Yeah, well, I mean, it was 75.
75%, yeah.
Well, it was 75p a share, which was roughly about 70-80% premium to the previous day. It was still actually only taken out on a 2.3 times EV sales multiple, so it wasn't actually that stretching. But it looks like a done deal because the main shareholders have actually agreed. But what it raises that if you've got an undervalued asset on the market, it's not a surprise it gets taken out. I mean, you've had just this morning St. Modwin. They're sort of like a land regeneration. They do a lot of sort of like remediation and putting houses up there and retail and all this sort of stuff, building construction and all that kind of stuff. They've redeveloped Longbridge where I live. Anyway, they've been bought out, or they've had a preliminary offer from Blackstone at another sort of like 20 odd% premium. So M&A is increasingly happening because we talked about inflation. As inflation goes up, it means that assets become very, very valuable, and certainly where you have synergies, then you can justify the prices because people can't make a return on their cash if interest rates are going to stay low and you see inflation. So you might as well invest it in sort of stocks and shares. And as I say, Polarean would be an absolute perfect position, I'd have thought.
Yeah, exactly. No, it's one of those companies, it's the longest one I've held, I think, for a long time. In fact, the last longest share I held was Lloyds after the great financial crash. And I went big on that. And I said big, for me at the time it was, because I had all my money in it pretty much. And luckily it paid off. But I had some sleepless nights over that one, thinking they're going to nationalize that bank. And I thought, if they do, the whole economy is in trouble here. But it paid off. But I mean, I held Lloyds there for 2 years maybe. But now I've held this close to 3 years probably. But it's done very well,
Talk about holding periods. I mean, we've obviously got. I don't know if you ever met the guy Zak Mir, who's now joined Vox.
Yeah,
he's an expert.
I used to have Zak on every day. Every day, three charts in 3 minutes with Zak. Yeah, on the podcast years ago. But nice guy, Zak. Yeah.
Yeah, well, he's an expert on all things chartist related, and I've challenged him because I'm an idiot when it comes to sort of the technical side. And I've said to him, right, next week I'm going to interview you, and you're going to take me through. And he's kindly accepted the challenge, my portfolio, to see where the fundamentals and the technicals align. So,
do you know what? I never look at. I mean, I see a lot of people doing charts and doing forecasts. You can't do that. You can't. I mean, I just think that's like Mystic Meg kind of stuff. All I use charts for is I look at the price action or the volume on something, or a good indicator I look at is all the relative strength index, which is based on volume and price movement. It's based on momentum of a share price movement based on volume. So it's real metrics. And then I look at, say, and it's valid from 0 to 100. Over 70 is regarded as overbought. That's when there's a lot of momentum going there, and it needs to calm down a bit sometimes, but it can be higher than that. And then all I look at is previous times it's done that, saying, okay, last 3 times it's gone above that, or above 80, it's come down within the next week. And so it helps you just time a little bit and don't buy a very hot share price. We all know share price go up and down, and the business underneath, it can be improving, but the share price can go down. So it's like, I look at charts to help me with a bit of fear of missing out. Hang on, it's way too hot. Last couple of times it's done that, it's come back. It's consolidated, So yeah, that's what I use charts for. So fundamentals, what to buy, charts, when to sort of buy really, because trying to check it's not gone crazy in the last few sessions or something, So that's what I use it for. But the predictions and forecasting, I see a lot of people drawing these lines everywhere, going nuts. It should hit, £10 by September. No. Well, you can actually do that.
Anyway, there's a dry.
If you can actually predict those kind of price movements, you'd be tanking Warren Buffett. Absolutely you would. You wouldn't. So yeah, I never believe in forecasts. So probability, I use charts for really, and just that's it.
Well, if anybody's interested, my fundamentals-based investing, 12 stocks in there are all going to be sort of like he's running the slider all over them, and one of them, was coming back to one of your longest holders, Lloyds, has actually done really well. I mean, it had its trading update the other day, and surprise, it said it was releasing its provisions, or quite a large chunk of its provisions from last year. It now has around £6 billion of surplus capital that could well be heading back to shareholders, which is around about 8p a share. And it's still not expensive, but that one's recovering. And I've sort of like, come to the conclusion that one's going back to sort of like, net tangible assets around about 55p. So there's no reason not to continue with it. And equally, I would say, let me just get rid of that.
That's Zak probably calling you up.
Sorry about that. We get these crazy people who ring me up and try and sell me stuff. And then the other stuff that came through in terms of my portfolio had Merck and Gilead, and surprise, surprise, because patients and people who are sick haven't been able to get screened for cancer and for other conditions, haven't been to GPs and to hospitals. They're sort of like anything that's drug related, which is associated with hospitals or GPs, hasn't actually done so well. And so they came out, they had missed expectations on their core businesses in Q1. The shares sold off, but then people realize it's all coming back, and they've moved back up. So that one's just as good sort of work in progress. And that brings me neatly onto a company that I interviewed CEO Wendy Lawrence of Totally this week. And if anybody's interested, it is well worth a listen to, because she gave me the rundown on the actual business. And essentially they do the 111 urgent care service for the NHS. Now, what's really interesting about that is two things. First of all, they managed to increase their capacity 4 times during the pandemic, from pre-pandemic to the top of the sort of like infection peak in February. And also the NHS likes the service so much, they're thinking about using it for, in fact, they may have already announced it, I'm not sure, for GP. So instead of running a GP surgery to book an appointment, you ring them, which again will continue to drive that. But the real beauty, I mean, the other real beauty comes in with the, sort of their planned care and their insourcing divisions, which are going to help the NHS get rid of the mountain of patient waiting list of 4.7. And that's just a really tip of the iceberg, because there's so many people who haven't been screened over the last 12 months. It means that list is going to increase significantly. And I say I saw that with Merck, and I saw it with Gilead's results. They said exactly the same. So what that means then going forward, and I put this question to Wendy, and she said, well, we don't know. Who knows how it's going to go? But we're really confident in our insourcing division, which basically brings in their teams of surgeons and healthcare experts, and does operations on NHS patients in NHS hospitals, and that's why it's called insourcing, over weekends when that equipment's not being used, to help get the patient list down. And she said, well, we could see it doubling this year and doubling again next year. And if you run that through, plus the mix in margin, I mean, last year in 2019, I think they did something like into March 2020, it's about 105 million of turnover, 4 million of adjusted EBITDA. I could see in 5 years' time, not a problem, them doing 200 million of turnover, 20 million of EBITDA. And given their market cap's only 70 million, plus they've got almost 15 million of net cash, this looks like a real sort of like, undervalued share that's got long-term growth, secular growth drivers driving it. And the quality of that business, having just come through a pandemic, and to stand shoulder to shoulder with the NHS it's been road tested. It's fabulous. The amount of goodwill that company has built up from the UK and from just generally the public from doing a terrific service means that they've got every chance of winning more business and absorbing more business from, as the NHS, frankly, are going to continue to really struggle because they've got unprecedented demand coming forward. So if you want a long-term sort of like small cap, £70 million, sort of like companies to have a look for in healthcare, Total is as good as any. So yeah, I would have a look at that. I was really impressed. She's a top executive in my view. She knows, she comes out to the NHS and she really knows what they need in terms of, making sure that the quality is first and foremost, both to the patient and to the actual hospital itself.
Yeah, I've interviewed Wendy a few times, and about years ago, I used to hold Totally, and
well, mate, if you ordered about 10p, they're about 40 now, so you'd have 4 bagged.
Yeah, it's another one I had lack of patience on, and
another one. Another one you had lack of patience on was Eleco, mate, and that came out. They came out with a trading update ahead of its AGM, and this is certain. I mean, I've owned this for 5 years. And they came out with unbelievably good numbers. They said previously, about a month ago, 6 weeks ago, that their year-to-date like-for-like sales, which is the missing piece in the jigsaw for this whole sort of like build tech story, had been 4% up to February. But for March, that year-to-date like-for-like sales growth had risen to 9%. And if you do the maths, that works out between 15 to 20% like-for-like growth in that particular month, which is absolutely fabulous. And if they can continue that, they'll absolutely knock the ball out of the park this year. Now, what was really interesting was that their house broker, FinCap, didn't upgrade their numbers. They kept them the same. And that was largely, in my view, just on ultra caution, because I think they're going to beat FinCap's numbers. But also, there's lots of levers that Eleco can pull. If it wants to, and just sort of like, get over what the market's expecting, then it can really accelerate its SaaS transition. It's about 56% last year, was the share of revenue. But it can really accelerate that transition from a perpetual model to a SaaS model. And therefore, that dampens your sales growth. Or if it really wants to do a like-for-like, it'll probably knock the ball out of the park and do 10% plus on like-for-like if it just kept its exactly the same mix of SaaS and perpetual license. So, and most of that just drops straight down to the bottom line because it's 90% gross margins. The cash is just fabulous. They're on about, I don't know, I can't remember what it was. It was about 7.9 million net cash at the end of March. PBT increased by 21%. So they've got lots and lots of levers they can pull. If they want to put in more investment in there, they can, because FinCap numbers is a very easy bar to get over in the top line and the bottom line, in my view. So I am absolutely delighted that business is really motoring. And I can tell you, I'm just going to hold this one because... Do
you worry, though, about it's stamp duty? Like I said, we've seen house prices rocket recently, and that kind of stimulus is always a bit worrying where it's a bit of a bubble, don't you think? I mean, because I said genuinely, I've seen house prices go up. Because I always watch, I'm always on the portals watching the prices, and I've seen them literally move up in the last month or two crazily, and I think that's ridiculous. I've seen houses worth something like 700 grand being priced at $1 million. I thought, no, your house is not like that. I said, and they're just trying their arm. Do you sort of worry? I mean, do you still hold Taylor Wimpey and stuff? I mean, do you think
just default to what Taylor Wimpey said like 2 weeks ago, on their trading update? The CEO said, stamp duty, yes, it's helping, but frankly, take it away. It doesn't make any difference. It won't make any significant difference. There'll still be huge amounts of house demand, and all of them have said the same. So what the house building industry is saying to the chancellor, take it away, because we don't need it. The demand is still going to be there. We can
I think they should take it away. I think it's inflating the prices. I've heard a lot of stories of people being gazumped, and people are offering house offers on not even seeing houses, and I think it does offer that sort of frothy herds mentality of people just, I need to buy a house. I remember it happening years back. I don't know. I was in Cardiff at the time, and I was trying to buy a place. It's just crazy. You get caught up when you're trying to get on the first rung of the ladder, the property ladder. You just can't afford it anyway, and you overstretch yourselves. And I think it's a bit worrying sometimes.
Yeah, it won't make any difference to the building industry, in my view. No. The demand is still there. And what you've also got, if you're going to get a continued strength in the housing market, you've also got all big infrastructure projects coming back. I mean, HS2 is really flying at the moment. And then you've got lots of other big infrastructure projects which are going to be happening. So I can't see, construction is going to be really strong for the next 12, 18 months. I just can't, and the stamp duty holiday is just a bit of noise, in my view.
Yeah, absolutely.
When it comes to Eleco, I mean, I'm just going to continue to hold that. The new management team have just grabbed that business by the scruff of the neck and really now delivering on the top line. So
how long have you held that?
I think I owned first bought shares around about 2015, 16, something like that. So that's where I bought most of them. And I actually think it's now my biggest position. It's one of the biggest positions. So looks like a home.
I'm scrolling back to 2015, 2016. We're talking about 20 pence there. Now it's 120.
Yeah, I think
25 pence.
I can't remember what the average price is. It's about 25, 30p or something like that. I don't know. But
when I first started in microcaps, because on Twitter, and I talk about this, and I have pre-recorded already the weekend podcast. I've talked about looking at companies going to be generating real value, and I say that by cash. Not there's a lot of there's some good companies on AIM, and AIM gets a bad name because there's a lot of resource stocks that get pumped and news driven. They've got no revenue, and they're not going to be generating real value. I call real value, which is cash, anywhere in the distant future. And so you've got to trade those. And so if you're new and you think you can hold on to a company that's a resource company, you can't really, and unless they're going to start generating cash flow in the next 6 months or something, you can't. So always look for companies they're going to be good businesses, going to get better, generating real cash flow, with within 6 to 12 months and improving that over time, and you can sit and hold. And that's the best way, isn't it, to create your own wealth? Just sit and hold in good businesses, not jumping in, jumping out, top slicing here, top slicing there. It's a false economy. That,
and that's coming from a trader.
No, I'm not a
trader.
I'm not a dirty trader. Listen, I tell you what, I used to, when I first started in microcaps, when you got a smaller pot, you have to go down the market cap size, to build up your pot a little bit. There's no point in you getting 5-10% a year if you've only got, if you've only got a couple of grand or whatever in your pot. You can't. You need to sort of double, treble your money. So you have to take on more risk. But and sometimes that means going in resource stocks. But you can't hold them forever. You can't. I think. Hang on. Someone said to me once, of the resource companies, explorers and resource companies, explorers basically, only just less than 3% will ever get to become a producer. But if you look at that, what, really? And this is a guy in the mining industry.
Ask me a question, Justin. I'll tell you what the question is to ask me.
Okay, go on then.
How many resource explorer stocks have I ever owned?
Oh, you used to love them, didn't you? So there used to be a portfolio was full of them. They used to call you Paul Resource Stock.
Zero. Zero.
No, I know, but that's right. People, I said on the weekend podcast, do me a favor, look at the top 1,000 richest people in the world. See how many of those are traders. See how many of those are investors. That gives you the answer. There'll be a lot of investors in there. There'll be no traders in there, And so to build real wealth, you have to buy a small company, but has the potential to scale. And you can just get in early and hold on, because that's where the balls are. The trading is not where the balls are. The balls are taking a nice little stake early on. And, it's sort of course, it's never going to run smooth. No business runs smooth. But as long as the general story is unfolding as you expect, holding on, ups and downs, and then all of a sudden it'll start rising. I saw a guy on CNBC once, and he said, listen, holding on is where you make the money. I think he said, if you look at Amazon, that's been so volatile. The drawdowns on that's been so volatile. And I think probably Jeff and maybe his wife are the only two people that held shares from the start to the end. But that is where the real monies are made. And there were times during .com, bust where everyone said Amazon's going through. If you looked at Amazon versus eBay and the capital spend on Amazon given to eBay, because Amazon can't afford to open warehouses, hold stock and all that stuff. And yet, look where Amazon are now, and eBay's been crushed pretty much, So, it's almost having that.
Basically comes as a good sort of principle. The reason why I avoid those type of really sort of like, bullet point type sort of like stocks, etc., is simply because the hit rate's so poor on them. And I just don't like having a 90% chance of losing money and a 10% chance of 10 bagging, because it just doesn't work. I just don't like that sort of optionality. I'd much prefer it sort of like a 60-70% chance of it being a winner and a chance of making 50 to 100% of your money. Those are type of stocks I like, rather than actually trying to bet the farm on a one-shot, one-trick pony sort of stuff, particularly with a probability of only 10% of success. So I try and avoid that. Now, what percentage of cash is in your portfolio? Just
I'd say round about the same as 10% on that. It's not round about that level.
Somebody tweeted that you'd sold your Trackwise Designs apparently.
Yeah. So, do you know what? I'm starting off obviously the Sharepickers Investment Club, and it's what's nice about trying to help others is you learn yourself as well, because you have to look things up and you look at your previous results and you have to really dig deep. And I've just gone over my previous winners, and they're of a certain level, certain size. They're doing a certain thing that maybe in turnaround it takes a while, but there's certain metrics you look at. You understand they're going to be heading towards cash flow positive within sort of 12 months. And I like that, going from almost loss making. If you can get that loss making where sentiment's low and they've been raising money and they get to the stage where they find it hard to raise money, all of a sudden they've turned it around. They're starting to come together. The business model is coming together, and that kind of, and I've held too many stocks as well. Just looking at diversification, like I said, having too many protects you against risk, yes, but it also protects you against reward. It's very hard to get some decent upside if you've got like 20 stocks or something like that. It's really hard. You'll follow the market pretty much. So
how many have you got at the market? How many have you got at the moment?
I've got 6 serious, but 9. I got the total. Yeah. And I know Trackwise is one. I like it, but I missed the big move in that. They came on the podcast when they first listed, and I liked it. I didn't really understand the tech too much, but I sort of liked it. You get this inkling, I quite like this. I don't know why, and I should have gone in there, and it moved. And I see potential 2-3 years out, but I look at my stocks. I've got to bring in below 10 stocks. I held about 13, I think it was. And it gets to the stage where, what are my core holdings? What do I not want to sell? Definitely. And then I start with one, then go to the next one. I don't want to sell that either for these reasons. And then I get to say, 6. And okay, I'm just going to get rid of the rest. And that's it. I don't need the rest because it's just diluting thing. So that's what I've done. And Trackwise, I think, good potential. But again, we talked about this. It's most sales you see from, sort of high net worths or from funds. Most of the time, it's nothing to do with the company. It's their subjective position. They need to readjust their book or whatever, or high net worth take some profit. Yeah, so it's just that. It's just my I've said to something, don't base my sales on anything, because I jumped out of some companies that done 3,000%. Before after.
So have I.
Yeah. So it's nothing to do with that. It's just my own personal, sort of portfolio management. That's what it is. Yeah. So.
Have you got your eye on anything at all going forward, or plenty? You just sort of like.
I've always got my eye on things, always,
Okay,
but I mean, it's come back to the thing. I mean, I do like at the moment. My core at the moment, little 3 are like, Polarean, Escape, and Infinity. I like them. They're turning around. They're getting better as businesses.
Which sector is it basically going to stay healthcare and tech? Is that your sort of your prime?
Yeah. Well, it's small tech based, but anything in a hot sector. But even now, I mean, I can't help having a little dabble sometimes on a reopening trade. I see reopening going to happen very soon. I see some companies leverage the retail sector, and I think that's a tiny market cap compared to where it was. Okay, they've got some risk there, but as we know, fear is our friend sometimes. If you get good management, a decent business model, very few companies go through. You can have a big hit, but this company, some of them are priced to fail. And I think, okay, I can't put a lot in it because it's not very big. And I don't want to talk about it because it's not. I wouldn't say this is amazing business, but I just think it'll do well on a reopening. So there's a couple I've taken of that. There's one I took recently, which was bombed out, and then a big fundraise happened, and some big guys came in. I thought, what's going on there? And so I like the tech, but it's always been bombed out. I'm not going to say it because it's basically tiny market caps, and I don't think they're amazing businesses yet. And I sort of don't want to promote them in any way. I haven't got hardly anything in them because they're too small. I can't really get any in a foothold. But I mean, I think you've got to have those kind of little plays sometimes. Well, you do. No,
it's awful.
But I'm already. Listen, I buy 2 companies, and literally, I'm already up like over 40% in one, and 20-odd% in the other, and it's just I want to see where it goes. It's not because I think it could be over time. Even they could get better, but who knows? But I may even just. I have one of those days where one day I say, no, listen, I want more cash. I've dumped them. And so that's why I don't share them. That's why I don't share them, because people say, "Oh, you just trade them." Yeah, I am, but I'm not promoting them. So I'm letting them go in their own steam, pretty much. So
okay, I would say, from my own personal experience, if you want to absolutely generate long-lasting, serious returns,
I agree.
You've got to have only invest, and you've got to be patient. You've got to be disciplined, very disciplined. Only invest in high conviction plays.
Absolutely.
Don't start diluting it in stuff. Okay, this sounds good.
No, I won't. I've said no. I agree, and I've said I'm never going to hold more than 9 stocks ever. Only 6 I'll play seriously. Yeah. But 9 are the ones. One of the core principles of this investment club I've got is like saying, if you are holding 20 stocks, even 10 or more, you haven't done enough research. You don't have enough conviction, because most of the people in my club are not millionaires. They are average or private investors, some of them starting out. And so I said, what you need to do, if you want diversification, get a fund, if that's all you want, and you want decent market returns. But you've got to research a company enough to have confidence in the company. When the share price goes down, you realize that isn't the business being affected. The business is the same, it should be improving. Don't worry about the day-to-day pricing of the business. That's the market. You just worry about the business itself, not the price of the business on a daily basis. And I say, you need to if you get decent returns, I say, you've got to have conviction in a handful of stocks, 5-6 stocks, and that's it.
And prepared to take a long-term time horizon on it.
Yeah, another one. Do you see this company in 3 years' time being a lot better than where it is now? And if you can see that, don't worry about the daily movement of the share price. That's going to happen, isn't it?
It takes a long time for the market sometimes, particularly in small caps, to catch up with what you've seen, and you've got to be prepared to be patient. I mean, it's taken me 2, 3, 4 years on certain stocks. You have to be patient.
Spot on. Do you know what? I've done that. That's why I jumped out of things. I got into they're hope hype potential stocks. But I got into things like Argo blockchain. I was in the powerhouse energy. And I was talking about that, and there's an alternative energy, and you realise the market's a little bit behind you. You've researched them. This company's like only worth 10 million, and it did like 6-7 bags within a month. All of a sudden, everyone's going carbon zero, net zero, and they think, oh, there we are, Paris energy, gas or high syngas, Bitcoin for ages. I did some videos on that, and Bitcoin. Then it's been on the blockchain, and then I lost patience, and all of a sudden hit 3,000%. What the heck? So now you have got to stick in there, have patience, like you say, and if you're good business improving, it's in a long trend sector, you're okay, and just having that patience, isn't it? I realize that after a while.
If anybody, as a trick, if anybody sort of like gets close to that impulsive button to push a sort of like a buy on a short-term trade, then just go and have a cold shower, okay? Because that'll stop you. To you, because those tend to be low probability investments and good gambles. So why bother?
Well, the thing is with trading is this. So I genuinely don't. This is why I do always have to go at dirty traders, jump in and jump out 20%. I think, what's the point? What is the point of that? Because to me, unless I can get a decent return from it, and that means having 10% or more exposed to it. And I got the conviction to take that position. There's no point me trading it. If I'm gonna get less than 2% of my portfolio, no point me. It's not gonna. And we have this. There's a lot of people, as I've started in the club, and they've got like 40, 50 stocks, and they've whittled them down now. As they're looking at what's your conviction, which one are you really convinced of, and it's the one you've done most research on normally, And I said normally, if you're worried about stock, it's because you don't know much about it. So get rid of it or do more research. And if it holds less than say 5% of your portfolio, either do more research and up your exposure, or get rid of it because it's not doing your portfolio any good. So, and normally that's it. People have worry about a stock because they haven't researched it enough. But trading is the same. I can't trade because I need to research a company to put a decent chunk in. So I can't really trade. That's why.
Good man. Well, that sounds like you're getting more disciplined.
Yeah. Well, that's it, isn't it? I mean, it's a skill, discipline, patience. It's a skill. Buffett plays a long game. He's 90. I love that.
Yeah.
So, but any other stocks you want to talk about?
No, I think that's it. We'll speak in 2 weeks' time, then, mate.
That's plenty. Thanks, Paul. Yeah, you got partying on the opening. What's 10 days left on the reopen? 5 trading days, actually. I think that's all it is.
You're joking, mate. Definitely not. No, it's too much for me.
Did you party? Well, but you got some. I tell you what, you've got some cracking escape rooms in there.
I know, exactly. Yeah. All right, mate. Take care.
Cheers, fella. Speak to you next week.